Hey guys, quick disclaimer, I'm currently not in Berlin but in Cape Town, so classic Berlin winter. But I just wanted to use this 30 seconds to give you a little update on the podcast. So the last 3 years we have actually been doing only podcasts with unicorn founders, serial entrepreneurs, one-on-one. Why did I do this? Actually, it's just very hard for founders to get in touch with unicorn founders and ask their questions at a coffee. So I started this platform to ask the questions founders would ask to their niche unicorn founders and build this podcast out of it. So now we're opening up for chapter 2, which is live podcast. Why do we do this? We know that for founders, it's just the best thing to ask their questions themselves. And that's why we started to think about, okay, let's maybe do a live podcast where we have a Q&A with the panelists, the unicorn founders on the panel and the founders in the audience. Now we have done this with Project A for the first time. We're looking forward to do this for another 4 or 5 times this year again, having a panel with 3 or 4 guests, unicorn founders or serial entrepreneurs, investors, and an audience, a very niche audience in a particular industry. So if you're a company that wants to partner up with us for an event in this year, then let's just get in contact, shoot me a DM. And for the people who have not been watching any of my podcasts so far, I have put the link down below for the newsletter and also for the Spotify. Make yourself an overview over what's been happening the last 3 years, and let's dive right into it.
So maybe, Philipp, you'd like to start about yourself, what are you guys doing at Project A?
Sure. Good to have you all. My name is Philipp. I'm a partner here at Project A in the Berlin office. Spent the last 10 years in the Berlin and London startup ecosystem, half of which as an operator. So I had the pleasure of building and leading marketing and analytics teams. And then I also worked with Sennder for a little bit as one of my projects. Couple of other companies, Trade Republic, for example. Really enjoyed that, and at some point decided to make the switch to the investment side of things. Ever since, trying to find the most exciting founders in Europe that want to have us on the cap table and invest at pre-seed or seed. And I tend to focus a lot on supply chain related investments and marketplaces, with a strong focus on B2B marketplaces. That's me. And Project A, I'd keep it short. We're an early stage venture fund, founded here in Berlin 12 years ago. By now investing pan-European. We have an office here, one in London. Team is split 50-50. $1 billion in assets under management, typically deploying at pre-seed and seed, with initial tickets somewhere between $1 million and $10 million. And we support our founders with the option of tapping into a fairly big pool of operators that all sit in this building here, that can support on the commercial side, people side, and product and engineering.
Awesome. Maybe you use cool. To continue.
Yeah, I'm happy to. My name's Julius. I've been in Berlin since 2015. Started a company together with my 2 co-founders named Sennder in 2016. We've step by step scaled that over the years since 2017. Project A as well as 𝗀𝗃𝗏𝗏 or 𝗀𝗁𝗄𝗏𝗃 at the time came on board as part of our Series A. So that's has been quite a strong connection. In regards to the company, we're roughly 1,600 people in total size. We do just over $1 billion in revenue, 1.3 billion. And I, for myself, have a very strong focus on the commercial side of the business. So I'm still very engaged in the day-to-day business. I tend to travel 2 to 3 days, meeting our customers on the shipper side of our 2-sided marketplace, where we've got carriers as well as shippers. Have been doing that for close to 10 years now.
Yeah, Martin, I founded Idealo in the year 2000 formally, running around probably with the business plan a little bit longer, but and did it 12 years, and then I went out of the company as an operator and again 12 years, and after 12 years I came back. Now I'm working again at Idealo with let's say a totally different setup. The company has become pretty big, but also a little bit too big in certain terms, so it's a little bit of a restructuring. but also finishing a lot of things that need to be finished. And but it feels good to be back with this distance of 12 years. I see a lot of things pretty different between. I did some investments and a lot of venture capital investments and a few operative stunts. Yeah.
Awesome. Thank you, Martin. Maybe let's start with a quick icebreaker question to everybody of us. Julius, what would you think is so different on being in the logistics sector with your marketplace company other than other sectors in the business scene?
Yeah, so I think what needs to be said first that we operate in a B2B kind of environment. You don't have any touch points with us in your everyday business. To kind of explain our business model very, very briefly. On the one side, as previously mentioned, we've got our customers, for example, Coca-Cola, based here in Berlin. And on the other side, we've got small carriers, mostly family-owned companies. In fact, 70% of all market capacity comes from these family-operated companies that tend to have 5 to 20 trucks in their fleet. So it's an extremely fragmented market on the one side, and then we've got these strategic accounts on the other side. And what we do is that we basically bundle the capacity from these small carriers and offer them to the large enterprise companies. So having that imbalance in our market basically is the ideal setup to have a marketplace or a platform where we manage to connect these two sides.
I think one of your co-founders already said what he's always telling to his grandmother is Uber for trucks.
Or FlixBus for trucking. Yeah. I think FlixBus is probably the perfect comparable, even though they operate in a B2C environment, and we transport pallets and not passengers. That's pretty much our business model.
Awesome.
In a different industry.
Philipp, let's go to you. At Project A, and maybe also from your perspective, let's stick maybe to platforms, but could also be other startups. What was your favorite investment case so far in Project A, but also from your side?
After Sennder.
Yeah, Sennder, obviously. I mean, it's always difficult to name names because we like all founders in our portfolio very much, right? I think obviously,
in there,
I mean, obviously, Trade Republic is making us quite happy. It's a fantastic journey working with them ever since we invested very early in them. When I was still in my operator role, I had the pleasure of working very closely with their CMO back then, Sarah. So I was kind of part of this hyperscaling phase. And I mean, Julius knows this better than me, but it's when you see this once, I think it's just fantastic to see how different it is from everything else you're seeing. I think we have a lot of companies that are doing very well, but Trade Republic clearly stands out in some regards. So yeah, that's just fantastic to see that you're growing faster than you can actually deal with. So that was really cool. And then on the marketplace side, I think Kira, who I'm doing most of my investments with, we have done a few B2B marketplaces. Sennder being the prime one a couple of years ago, and more recently, I think there's a new wave of these companies. So that's what keeps me excited at the moment, because I think a lot of building blocks right now that weren't there a couple of years ago, where you guys had to invent all of that. And now there's we can talk about that a bit, I guess. A lot of building blocks fell into place so that it becomes a lot easier to focus on the core business, and you don't have to build all the rails from scratch. So that's where we're spending a lot of time.
Got it. Martin, building a price comparison platform in the, as you already said, early 2000s, what maybe would have changed if you start building a marketplace for that in those days right now?
Oh, I would say for every business model there's a period, and actually there was probably only this period to build a product like Idealo. So if I would do something now, I probably wouldn't do a price comparison, but something what you could see in the portfolio of the VCs at Project A. So, and I'm not totally sure if I would create a marketplace again. So that is a good question. If you look at the process of what you do, you probably do something you have a lot of experience with, and I cannot relate to the situation right now in the way you probably did what you did, because you had some experience with the logistics, and so I probably would exactly do where I have some experience in. What also was pretty different in 2000, because there was a lot of business models where the people didn't have any experience at all, and I didn't have any retail experience when I started Idealo. So that's probably pretty different to now, that people have sector expertise, and this kind of sector expertise gives them a pretty good idea about the needs of the industry, and then they capitalize on that. So that's probably how I would do it. But as I don't have this kind of experience, I cannot say what I would do now.
Got it. Okay. For everybody here in the scene, we are having a Q&A afterwards, so you guys can get a microphone and ask your questions to the speakers here as well. So I will start maybe with some core questions that you guys don't need to ask anymore. So the first one would be, how important is it to build trust on each side of the party when it comes to marketplaces platforms? Because trust, of course, in general is very important, but building trust from scratch with two parties to convince, how is it workable?
Maybe I'll start. I mean, as I mentioned, we have these two sides, and despite there being hundreds of enterprise accounts on the customer side of our marketplace, those are absolute key for us, and they are the ones that basically have allowed this exponential growth over the years, and we've always sort of taken a very old school approach when it comes to these customers, meaning that we still drive around, we visit them on a regular basis, and we maintain and serve these relationships as their absolute key. And if one of them drops out, it could have quite a substantial effect on the business. Keeping in mind that we now not only serve Coca-Cola in Germany, but we've grown with them into different markets. And of course, I mean, everything is somewhat connected, and these offices speak to one another. That has remained an integral part of the business, we've taken that old school approach sort of since day one.
Okay, so building trust by also retargeting those clients that have been putting trust in you early on.
Exactly, and
got it.
No, I'm laughing because an hour ago we recorded a video in the office to win some new business with Coca-Cola, and I was wearing a Fanta T-shirt, and we built a nice story out of it, and we're going to be sending it. We're going to be sending it to the team. And I think this is the kind of stuff that somewhat sticks with the people. It's potentially being forwarded within the organization, I think this is what it takes to build a strong relationship, because it doesn't always go up. Right. We've also been in super difficult situations. For example, if in the extreme case it becomes 36 degrees outside tomorrow, the consumption of Coca-Cola goes through the roof. And of course, in order to restock all the warehouses, the supermarkets and so on, capacity is needed. And that capacity doesn't come overnight. So it's times like these where I think a good customer relationship can cut you some slack.
Awesome. Anything to add from you two guys?
Yeah, maybe building on that, in the younger B2B marketplaces that we backed, we see the same thing, that it's vital to in the beginning go and meet your customers in a very old school kind of way, which I think some founders also sometimes underestimate, because we want to build digital scalable companies and suddenly you have to go on a yard and speak to people and do actual classical business. But I think that goes a long way to build initial trust. And then obviously what you often see is that they're being tested also by their customers. So you'll have like test orders. So they give you a little bit of allocation to see, hey, do these guys actually know what they're doing? Can they handle this? And then you get a slightly bigger order with some other challenging criteria, and just to test, hey, is there something to this? So you're still in these digital models earning your trust over the time. I think that is quite important to understand, that that's going to be part of the customer interaction from day one. And then obviously that's also a big part of what a marketplace does, right? I think in the past we've seen a lot of more matchmaking marketplaces where the transaction didn't necessarily go through you as the party. Today, most, at least B2B marketplaces we're seeing, are actually following a merchant of record model, so that the order goes through your books. So basically you're building that trust by taking care of the whole value chain, right? You're not matchmaking a buyer with a seller. You're basically not showing who is the buyer and who's the seller, but you're taking care of delivering the order and taking care of invoicing, etc. So that implies a lot of trust towards you before somebody really shifts from knowing a customer to you being the customer or the supplier. So I would say it's the vital part of any marketplace we're working with.
Good. Martin, anything to add, or should I move to the next question?
I mean, it is pretty much the same. So even if you run a B2C business, you have the trust issue on the side of the merchants, and you have the trust issue on the side of the buyers. So in the very beginning, Idealo had from the very beginning, Idealo had a very strong focus on the buyer side, because actually in the old times it was pretty unclear to a lot of people who are these people on the other side. There was a lot of regulation not yet in place. So what we did was kind of building a relationship with the shops by really looking what they're doing, and we probably were the only comparable organization that did very deep reference checks on them, and probably we also were the first to take them down if there was something fishy and irregular. So we had very high standards. But what I think Idealo did not good so well in the last years, and I think we will correct that in the next years, hopefully in this year, is to build or extend the relationship with the merchants. So even there is, when you say you have this very deep integration and you have the transaction, we decided to not proceed. We had this marketplace, or we called it a 𝗕𝗓𝗄 feature, where we really were tunneling through the transaction. We were kind of a payment provider. But in the very end, I would say that's not really what we need to do, because there's a lot of marketplaces in the market and we don't need to provide another marketplace experience. But there's a lot of other stuff probably price comparison needs to do, and when we look internationally, some price comparison do quite successfully. For instance, extending the reach into other areas. We are providing them, helping them with the data feeds, stuff like that, or even helping them with the evaluation of other channels, because they trust us. They know we very much look on the conversion. So when we look, very good example is one price comparison in Czech Republic or Rijeka. They do a very good job. They have 80% of the transactions they are tracking from all of their partners without having this transaction running through their marketplace, but they know the transaction. And they are optimizing on the success, on the cost revenue rate. So that's definitely something we need to extend in the future, so we can be absolutely aware that our partners, the merchants, are doing very good business with us. And that's also something where we probably can extend our value creation for them by doing, for instance, retail media offers and stuff like that. That's definitely the future, and that's definitely something Idealo should have done much earlier.
Interesting. So I had a podcast regarding marketplaces. That's why I actually came to the topic earlier, or later last year actually, with Speedinvest general partner, or former general partner, 𝗕𝗫𝗃𝗲𝗃𝗲. Maybe you guys know him. And I asked him this question before I'll answer his answer. I wanted to ask you guys, what would you do with the common chicken and egg problem that we call it in the marketplace business? So not having one party, but the other party doesn't want to come because the one party is not there. So how would you handle this kind of problem?
I mean, the question is, how did we handle, because we are not in the situation yet, but actually we listed them for free in the very beginning, because we wanted to solve the problem building or providing the product to the end customer. So we were listing for free, or for a, let's say, very, very cheap CPC, and really only looking on the product that we had the best shops on our platform. Mm-hmm. And then we probably did a good job with SEO, and we got a lot of traffic. And then some of the shops realized that we were really providing a very good service with a very good conversion for them. And it was really interesting because that was so interesting in this early period. There was so much on trust. Actually, I had a phone call with them, and then they listed their content. And after 2 or 3 months, we had situations, the traffic grew and grew and grew, and the bill got bigger and bigger and bigger, and had the situation that it was really a repetitive pattern. They said, oh, the bill got so expensive, I canceled the service. And they did it. I said, okay, just give us no data, and you will be not found on the marketplace or on the price comparison, and you don't get any traffic. And we had this situation where really angry people called us because the bill was so big, and then they stopped the relationship with us, the cooperation with us, and 2 days later they called us, sorry, can we go back on the platform ASAP?
Crazy. Yeah.
We don't have any orders. And they realized that they were 100% dependent on us. So there was a lot of shops that were not really be able to understand where the traffic came from.
Yeah.
And we had this situation, especially in this period between 2002 and 2009 or so, very often that they really didn't, because they were not able to track the traffic, they were not able to handle, they were merchants but not able to do all the tracking or the other things of e-commerce. So there's probably still a lot of merchants that sell 60-70% of their stuff through us, and
interesting.
Because it's a very simple channel. You give us your data feed, and then you will get a lot of transactions.
Julius?
Yeah, for us, we basically started out and looked at what are the pain points for each of the sides, and basically what we need to solve in order for the two to kind of work together. And if we start with the customer side, the Coca-Cola side, it was all about capacity and having that flexibility. Capacity on the one side, that if they require 10 trucks today, that basically there's one partner that can supply them. Second, having that flexibility if it comes summer out tomorrow, that they can basically ramp up overnight or handle this volume volatility. On the other side, for the carriers, it was a bit different. They didn't have any planability. Basically, they would drive from Munich to Berlin today, and then they would go on a type of platform, offer their capacity, and then would look for basically how they would continue their journey from there on. And then the second point was basically the cash flow that was super hard for them to handle, because first they didn't have the capacity that Coca-Cola needed on the one side, and on the other side Coca-Cola would pay between, I don't know, 30 and 90 days, or that's like the standard in the industry, but a company with, I don't know, 5 or 20 trucks in the fleet can't sustain payment terms of 90 days. So basically what we did is that we built this value proposition saying that, okay, let's offer that capacity bundled. We'll handle the payment terms on the one side and pay our carrier within 24 hours. And that suddenly gave us this competitive advantage that we had access to a ton of capacity, and we allowed these carriers to tap into a market that they didn't operate in before, because they were primarily working with other small SMEs that would allow to pay them quicker, but they didn't have that access to such a huge market, to these volumes that allowed us to basically plan their entire route for an entire week or for 2 weeks or an entire month. So step by step we try to scale these sides. That's sort of like when we started gaining momentum. But in the early days we basically tried to tap into all kinds of markets. So we're working with a local farmer where we transported 1 truck full of cucumbers and basically matched that with a carrier, and then step by step, after planting the seeds with the large enterprise customers where we had closing cycles of 6 to 12 months, we started getting these first volumes after having the test runs that Philipp mentioned earlier, and then step by step managed to get the liquidity into the marketplace.
Got it. Okay, interesting. Philipp, anything to add? Or?
Yeah, I mean, those are 2 strategies, and I think it's a lot of testing to get to the one that might work. What we see sometimes is, I mean, if you're operating in a market where you have supply constraint, I think then you're in a lucky position, because that means you just have to hustle to get some supply, and there will be demand that you can match it with. If you're lucky enough to have access to VC money early, there are other strategies you can follow, like sacrificing margin initially and thereby just being a cheaper alternative on the market, so you naturally will have demand for that. Or you could try and alleviate a pain that is in the transaction. One of them being, for example, accelerating payment, right? You could do that on your own balance sheet in the beginning if you have sufficient funds. Or you make document handling in a transaction a lot easier, because you have a SaaS solution in place on your end that might be quite scrappy, but it's still already adding value to the transaction. So there's so many ways. But obviously, as a VC, it's easy to say that. In the end, you have to. It's a lot of theory, trial and error, and then hopefully you'll end up with something. But yeah.
Yeah, Matthias from Speed Invest gave me a great answer as well, kind of like yours. He said that if you provide value for one side of the party first with a software or something that creates data as well, then you can easily onboard the second party afterwards, after 2 or 3 or whatever years, and match them immediately with, I mean, for example, let's take a look at, I took a look at a recent startup. They do a CRM system for influencer agencies, and on the other side, the talents, like the influencers, are having a kind of calendar look, and they can be booked by companies on this app. But first they had a CRM only for the companies that wanted to book influencers and just did the payment for them, and afterwards they onboard the talents and the influencers. So it was very, very easy to scale that. But yeah. Next question regarding mistakes, because I think that's a lot of stuff that they can learn from here. Maybe let's start with you, Julius. what's like the biggest mistake? Let's maybe stick to marketplaces if we can, to building up this marketplace from your whole co-founder team.
Good question. So I think overall we pursued the right strategy. I think what we should have done right from the early days is focus purely on these enterprise customers, which is something that we didn't do. We basically transported everything, as I said, from the cucumbers, pretty much everything that we could get our hands on. At times we did courier drives. We transported a laptop from Berlin to Dresden, which we did to kind of generate revenue, to build a story, to get Project A, on board. That's something like which I probably wouldn't do again. I would just sort of take the time and sort of properly build a sustainable business model, where I think it also must be said there was just a different time back then. It was all about top line growth, whereas now suddenly people started to look at the bottom line as well. So I think that's something that I would do differently, and rather than like continuously patch, which is also something that we did in the early days. And we always said every time the company doubles, we basically need to rebuild the entire thing. To simply just take more time, to build a more sustainable kind of infrastructure.
Got it. Martin, I think what's maybe interesting is telling more about the fuck-ups from the early 2000s than from now, because you're now fresh into the company again.
Internet outage.
Actually, there was a lot of wild things, but luckily we didn't really fuck up. So we fucked up the financing round, but that was due to the situation in the financing market. There was no chance to finance the company, and actually that was the best thing what could happen to us. So because actually it meant that we're not able to raise money. It meant anyone else was also not able to raise money, and this means you are in a situation where no competitor is coming up, because you are there and the only thing you have to do is to survive. And so that luckily drove us into exploring all ways to find good traffic, and SEO was probably the most sustainable for us. And in that way, we didn't really fuck up in that period, but we had the typical fuck ups. We had two people in the cap table that we didn't kick out early enough, and stuff like that. That's probably the usual startup fuck up.
Yep.
You join forces with people that are not sustainable for the company. And I would probably fix that earlier and faster, and things like that is probably. But that's not really a marketplace related thing. It's.
I think you tend to forget all the shit that went wrong on the way. At least you try to blend it out, but the gray hair doesn't come from nowhere. So.
Sure.
I mean. In that dimension, we fucked up a lot of things. So wrong focus, doing side projects. So everything what we did as a side project was doomed to die, because actually when you have something that's really going exponential, then everything what sounded so interesting today, it's kind of totally irrelevant tomorrow. So if you're on an exponential route, then probably one really stupid fuck up you can do to focus on side projects, because they are in a total different stage, and they probably won't go exponential. So side projects only make sense when your core business is not going exponential. that's definitely something what we kind of did wrong, but it has kind of self-healing effect. You do it, but then your business is growing so much, and you know, okay, I have to throw this away. It doesn't really make sense to pursue. But even this, I wouldn't call a fuck up, because it doesn't really. If you grow exponential, these things come so fast that you realize, no, let's not focus on that. Let's really focus on the core product. But if it would have grown slower, it could have harmed us relevantly, having not enough focus on the core product.
Got it. Okay. Yeah. Philipp, maybe let's turn the question a little bit for you. What patterns, mistake patterns, failure patterns do you see usually when it comes to founders maybe only applying for project A and not even getting investment?
Yeah, so I mean, sticking to marketplaces, I think adding to, or like summarizing a little bit also what you said, one thing we often see is premature scaling, right? So thinking you have some traction, so this is what you want to double down, and then basically you're burning money by thinking there's something here, but you don't actually have a business, right? So there's no bottom line. You're just basically being cheaper than an alternative, for example, but you won't be making any business. You're just generating top line. I think we see that sometimes. Then I think specific to marketplaces also at a later stage, some companies caring too late, I think, about marketplace liquidity. So sometimes you see growth stagnating a little bit, and then companies don't really understand why that is, because by that point, they might have lots of different kinds of product or categories on the platform from different geographies, from different customers. So it's sometimes a bit hard to understand why are we stagnating. So having like a data infrastructure in place where you really are able to understand, okay, where in our business, especially in B2C marketplaces where it can be very broad, where are we actually suffering right now and not growing? Seen a couple of companies build that up quite late when they realized, okay, we have a problem, but we don't really know what it is. And then there are more like non-marketplace specific things, I think, that we see across the board is like hiring the second level hierarchy too late, that the founders continue to do like a lot of the things on their own because it worked, right? And then they focus too late on handing over and building a scalable organization. I think those are like typical things there's more mistakes, and it's always easy as a VC to point them out because I'm not building it, right? So biggest respect for all the builders out there, but we have the luxury of seeing some patterns emerging, and those are probably 3 examples.
Awesome. Thank you. We are now 40 minutes into the panel, so I would like to open up for a Q&A session now. So maybe if we can get a 5th microphone to...
I think we have this,
here.
which serves as you have to speak into this, which is the microphone.
So you can throw this, and then it doesn't catch the sound while throwing, but when you speak into it. So maybe if somebody of you has the first question, I think what's really smart for you guys would be if you have a B2C question, of course, ask Martin. If it's a B2B question and something correlated to that, it's Julius, and for the investor perspective, it's Philipp. So yeah.
Thank you. My question will be then to Martin, because I think it's more related to a B2C part. I'm just wondering, in as a Idealo user as well, I was seeing that you started offering one-click purchase kind of offerings, and from that perspective, do you see that actually really helped you, in terms of for the users to be more engaging and buying straight away from you? Or do you have also issues there from trust perspective as well? Because the user might think that, okay, I'm gonna buy from you with one-click purchase. If there's an issue, who I'm going to handle that with? Is it gonna be the real merchant or mediator, basically? So how do you handle that situation?
When we are at fuck-ups, this is definitely a fuck-up, but I did not mention it because it more or less, it was not my mistake. Let's say it like this. So why was it we discontinued it 1.5 years ago. So why was it a fuck up? Actually, with this feature, we were creating kind of transaction on our platform, but it was competitive with a lot of other marketplaces which were also happening on our platform. Which problem did we solve there? Okay, a kind of UX problem that you could buy with one click, but that could have been probably also with other, let's say, methods. But that's more or less the only thing. You could probably have done a little bit more retention with having owning the transaction and a few other side effects. But in the very end, building a marketplace only makes sense if it makes sense to have a direct relationship with these kind of merchants, retailers. And what kind of merchant and retailers is it? These are the ones who don't have an online shop. But how many are they? They are not very many. And all of them are on Amazon, all of them are on eBay, all of them are on a few other platforms. So actually we were competing with this feature with the mentioned marketplaces, Amazon, eBay, and so on. And it didn't really strengthen our relationship with them. So the fuck up was twofold. One part, we invested, or the company invested a lot of money in that and wasted a lot of money, and did not really see that there was no real business model on it. So when with these kind of transactions, we were making 10% more margin, but from the cost side, we probably did 30% more cost. So it was a huge loss, aside from the investment, which was also huge. And the company was able to do it as an MVP or in a way. So that definitely, and the company was not able to understand the unit economics of that. So it was always miscalculated. So if you look at the transactional volume, and then it made sense, but actually that was the wrong perspective looking at it. You should have looked at the extra margin you were creating by that feature. And that's definitely something that counts for all marketplaces, not B2C marketplaces. If you provide something, it is really necessary to look at the extra margin you create on the platform, or the value you create on the platform. Either it is retention, or it is kind of delta you create on your existing business model. But when you do something and you pay €3 for every euro, it definitely doesn't make sense. And I really, from the perspective now, I really don't get it that was not understood in that period. But in the very end, it was understood, and then the service was discontinued.
Thanks.
Yeah.
Thanks. Right, so this question goes probably to Philipp. So as a VC, what signs of success do you index on? And specifically looking at examples with Sennder, for example, where cucumbers have been shipped around, or laptops, just to generate transactional value. Do you, for example, also index on verbal confirmations from larger customers like Coca-Cola in that case?
Yeah. So it really depends on the stage we're looking at the company, right? At pre-seed, there's typically not very many transaction-related or traction-related signals at all. So there, it's mostly like the backgrounds of the founders. So we try to meet the founders and get a good grasp of, like, do we think that the potential is there, and do they bring, and that's what Martin said earlier, today domain expertise is super key if you're building something. Probably wasn't the case 20 years ago. So that's mostly on the team, and then obviously some checks on market, which is the second most important, especially is it big enough, etc. But we acknowledge that a lot of things will change at this stage, so we don't overspend time on the model, etc., because in the end, we need to back a team that will figure it out in an attractive market. So it sounds fairly simple, but it's probably the hardest. It's harder than investing at Series B when you have a lot of traction signals. At seed, when you typically have like the first traction that you want to see, it depends. So in a marketplace, I think what we want to really understand by then is what are the insights that the team generated from various, maybe random even transactions, so also shipping cucumbers, that could yield interesting insights, right? That might be attractive or it might be unattractive, but where did that lead you, right? How did it change your thinking? And then obviously the further you go, so at a bigger seed or at Series A, you want to see like, hey, how fast is the traction growing year over year? Is there actually margin to be made? So what does the unit economics look like? What are products we can put on top? Like, can we charge for the SaaS enablement? Can we charge a financing product on top, right? So what is the growth levers that we can pull on top margin-wise? And then, like how do we scale this? And is the team showing us the first signals that they can bring people on board, like A-class talent that builds this together with them? So it's really stage dependent. I think the further you go, the more it's like clear insights on traction, and the earlier I think it's just like intensity and velocity of iterating on the idea.
Okay, and what kind of information has been generated and how it's structured?
Yeah.
Cool, thanks.
Awesome. Another question back there, yeah.
Okay, so thanks for the great discussion so far. I would have a question regarding, let's call it defensibility. So if you are running a platform or a marketplace, especially if you're following kind of a matchmaking logic, how do you make sure that after, let's say, a few successful, rewarding transactions, you are not bypassed? So how do you make sure that in your case, Julius, the shipper and the carrier do not establish a direct relationship among them, but still go through you? Or how do you assure Martin that, for instance, the merchant does not reach out directly to the consumer, offering him something that has at least the same price and on your platform? So how do you make sure that after the first, let's say, transactions, you're still in the game?
Yeah. Maybe I'll start. For the companies that we work with, the likes of Coca-Cola, their core business is beverages, and their core business is always going to remain beverages. Now, back in the day, Coca-Cola used to run a fleet themselves, and you still see some Coca-Cola trucks, the 𝗀𝗵𝗲𝗃𝗲𝗃𝗃, on the streets, but those are primarily used for sort of like distribution transports. Now, the entire infrastructure of these enterprise customers is not built to work with hundreds or thousands of small carriers, which make up 70% of the market capacity, as I mentioned. And that is sort of like the core stickiness why we, as a middleman operating this platform, can basically sustain in the market. Now, when we look at the side of the carriers, what usually happens is if you contract a large logistics player out in the market, I don't want to mention any names, but is a type of multi-layer subcontracting that if they don't have the truck themselves, they find somebody else in the market who might not have the capacity at that moment in this location, then phones up somebody else. So we tend to have between 3 and 5 middlemen in every single transaction. Each of these middlemen take a cut of 7 to 10% of the margin. Now, what we basically do is that we cut out these layers, work directly with the small carrier, and offer that to the enterprise customer. But it's basically having that knowledge around the carrier market and knowing where the assets currently are and where they are needed. We look into the weather forecast and basically know, okay, capacity is going to be needed for these industries tomorrow. Is basically what gives us the competitive advantage in not being cut out in these transactions.
Yeah, regarding Idealo, actually we expect, especially the online shops, that they try to cut out us. And it's part of the game because they want to win the customer through us, and then they want to do the retention with them. But actually that doesn't really work well because you typically don't buy so often, and even with Amazon, where people have a very direct relationship, and a lot of our retailers even track that. What is the incremental value of Idealo? Would they, if there was no Idealo, would they come to them? And they still, despite they really want to create that direct relationship, they still work with us. So that's definitely part of the game, that they want to cut us out. So we obviously have kind of a value that makes even a customer of Amazon go on Idealo, and in the very end they make their transaction at Amazon. And that's definitely the feeling that they make a good deal. And what they realized, that if people have the feeling that they make a good deal, that they do the transaction, and if they don't have the feeling that the deal is good, they don't do the transaction. So we are kind of sometimes or pretty often create a transaction that wouldn't happen with your own customer, because the customer needs to be convinced that it's the right decision. So we have value in that decision process. But there's, let's say, another situation where we are kind of the middleman, if you look at the traffic generation, because a lot of the traffic is, especially let's say the free traffic, comes from Google. So as you know, we have either on the one side we have a good relationship, because actually today we looked at what we spent at Google in the 25 years, and it's about nearly $1 billion what we paid to Google in the last 25 years. But on the other hand, we also have legal situation, because Google tried to copy our business model and tried to, it's called self-preference, try to self-preference themselves, so that even the EU, which is a very slow organization, was in coming to the point that was kind of ridiculous and against all legal regulations towards this kind of activity, self-preferencing. So, yeah, but in the very end, we are still in the situation, but it's kind of, and that's definitely something that also come in some other situation, that you have this relationship, but there's also either the let's say the state and the regulations that can harm you, and on the other side that these kind of very big infrastructure players that abuse the situation. So means in the very end we are kind of a middleman ourselves. What we will do in the future against it, we probably will heavily invest in retention measures. Means already more than 25% of our users coming through the app, and another, let's say, 25% are coming directly to Idealo and start their search at Idealo, and we need to extend that and create more value, and probably there's a lot of things around that we need to create for our customers, that they start their journey more often on Idealo or with the app than they do now. So it probably needs a lot of improvement still.
Maybe quickly from an investment perspective, because it's one of the questions we always ask, is disintermediation. And I think, as I mentioned earlier, what we see a lot in marketplaces these days is that you actually conceal the two parties from each other, so that you are becoming the merchant of record, so that the buying party doesn't actually know who the supplier is, thinking you are basically their contractual partner, so there's no way for them theoretically at least, to understand how to disintermediate you because they don't know the supplier. And then another one is obviously making the transaction so seamless and abstracting all the complexity away that there's no incentive for them to move around you, right? And that could be logistics, can be financing, that can be a SaaS solution that has all the order details in there, so it's a lot of pain for you to do that manually on paper, etc. There's different ways of doing that, but those are typically the two angles that most marketplaces we see in the B2B space follow.
Thank you very much.
Hi. I have a general question about marketplaces. So I wonder, what are signs or patterns in a market where you would say, oh my God, I'm so bullish, go founders, go and build a marketplace there?
Maybe I'll start. I think first is the market size, which Philipp mentioned earlier. For us, a 400 billion euro market. Take a look around. Everything that you see came here by truck, so that makes it kind of interesting. And then I think second thing is the fragmentation that I mentioned, where you have high complexity in basically managing such fragmentation. And then maybe the third thing is like information asymmetry. I would say, yeah, it basically boils down to those three things. Can I mention your market that I would go into right now? Not from the top of my head. No, but you have something to add, or Philipp?
I mean, let's chat, but I think you mentioned, I think, 3 of the 4 criteria. I think next to information asymmetry, like probably high transaction cost is the last one I would add. And you often these days see that if the transaction is cross-border or cross-continent, right? Because there's complexity, as you mentioned, in like the logistics involved and the customs involved, and hence also the transaction costs are high. Markets we're looking at recycled plastics, I think is interesting, for example. But it can also be a lot of B2C things that I'm not aware of. I think there's still a lot of also B2C marketplaces to be built. But typically what we're spending time on is really on commodities that are not entirely commoditized, because there are like geographic disimbalances, for example. Like we invested in a marketplace that is focused on metals recycling, so basically buying metals here that are prone to be recycled, and then most of the smelters sit in Asia, so they basically sell to Asia and they handle all the complexity in between. That's one of the examples. If you are familiar with a market like this, I think that helps, obviously, because that's hard to spot if you don't have any domain expertise. Hence, coming back to Martin saying earlier that today, typically, at least one of the founders brings domain expertise and has seen the problem firsthand.
But
otherwise,
us,
impossible.
Like none of us had literally no logistics experience whatsoever. Since around 3 weeks, I actually have my truck driving license. So
Congrats.
Yeah, we looked at the market, saw the size, and then kind of spotted the opportunity. But we also pivoted, or David, my co-founder, pivoted because the first approach didn't work, and then basically we reinvented the company to what it is today.
Yeah, I'd like to add to these 4 points that actually should be a standard when you assess something. But when you meet a high level of frustration, it's definitely something you should dig deeper. When you get this level of frustration, then people always probably are happy to talk about what they need and where you could help to solve a problem for them. So and very often people are not really aware how the problem could be solved. That's definitely something where when you talk to the market, people are very fuzzy to explain that, and when you kind of find that out, what is a substance to that, that's probably an indicator that when the other 4 aspects are given that it's worth digging deeper. Yeah.
Awesome. I'm very surprised that the word of AI hasn't fallen yet. So that's great. I think we can take another 2 questions, and then we'll leave it by little networking with pizza, because the clock is a little bit
Is the
drowning
pizza
us.
already here?
Could be, I don't know. But
Delivered
yeah,
on a truck.
perfect. Let's continue.
Regarding the topic of enterprise accounts as a B2B marketplace, sounds super logical that larger share of wallets, not just one side, one buyer. We're in a similar situation on-demand manufacturing marketplace, and obviously there is the standard default customers, startups, scale-ups who also don't have a procurement department. For them, you solve an immediate problem. The enterprise customers, the Siemenses, the BMWs, etc., endless share of wallets, but they have procurement departments. They have people. They have complicated onboarding processes. I'd like to get a little bit of your experience, how you started to learn that switch to the enterprise customers, and then how also you really managed to break in as a, back then, a new kid on the block, because ultimately that's quite a bit of a challenge.
Awesome question. Yeah.
We always said don't lie, but bending the truth was allowed. And I think in the first months or years, we kind of oversold the business and what we actually could do and how we've positioned ourselves in the market in regards to company size, when it comes to revenue, when it comes to employees and so on, and basically try to buy credibility or build credibility for something which wasn't there at the time. We're operating out of a garage in Berlin-Kreuzberg, and that sort of paired with an approach which was somewhat common in our industry, but wasn't always lived, were these personal meetings. That we were really there for the customer, listened to the needs of the customer, listened to these pain points that I mentioned earlier, and then built this relationship that I would say kind of offset us from others in the market. One of our investors always said, if Amazon asks you to jump, you're going to ask them how high. And that has been sort of our approach from day one, that we try to identify these pain points whenever they had one, and then basically try to solve exactly that pain point. So I would really leverage these personal meetings, because that's when you can get the most out of the customer. Listen more than you speak. Is what I always tell the salespeople, and then know your shit. And I think then you can sort of take sort of the first step. For you in the manufacturing, I would probably, and I mean, I don't know your industry, but I would probably start with sort of the prototyping, which is the type of testing that Philipp mentioned earlier, and then basically prove yourself through that, and then step by step try to go into the serial production. But let me think on it a bit, and then happy to chat over a slice of pizza.
I wanna.
Yeah, no excellency, please.
One more question to Julius. How did you introduce standardization between the parties? So in terms of documentation, the market on the one hand was very fragmented. How did you go about it from the start?
Yeah. Starting with the customer side, the Coca-Cola side, we basically had two options. Either we would build a solution and go up to Coca-Cola and tell them this is what you need to work with in order to work with us. Or what we opted for is to basically build a solution kind of around Coca-Cola. And in order to make that work, we built multiple integrations through EDIs, APIs, etc., and integrated sort of with the key TMS, the transport management systems of these enterprise shippers in order to receive the loads. So whether it comes out of their SAP system or, I don't know, their in-house system. Today, we can basically process the load, and that's what it basically allows us to manage these volumes on a daily basis. On the other side, given the fragmentation of the market, we took a different approach. Rather than building ourselves around the carriers, we said, if you want to work with us, if you want to drive for us, this is what you need to work with. And we tried to kind of enforce our infrastructure, our system into the market. For them, that was super interesting because they suddenly had a planability tool. They used to do their weekly planning with a piece of paper and a pen in the past. And suddenly they knew, okay, my truck is utilized for the next 2 weeks. Then we basically turned the entire payment process around, and instead of basically them issuing us an invoice that we would then pay, we immediately put them on a credit note system that we would just issue a credit note, and then they had that processed, and they could immediately see when they received their funds. So we tried to take as much work away from these carriers who would simply like to do one thing most, which is driving. And anything that requires, I don't know, IT infrastructure, etc., it's just not their natural habitat. So we tried to take as much of that away. So yeah, it was basically that approach that on the one side we built around, on the other side we kind of enforced, yeah, which proved to sort of be the recipe to success. That answers the question.
Yes, thanks.
Awesome, thank you. Let's now go to the open networking session. We have some pizza. I don't know if it's already delivered. Ben, are you here? 10 minutes? Oh, okay, so we have 10 minutes still. Okay, so we can maybe take some 1 or 2 more questions.
So as we cannot ask so many more questions in the future, what would be a book that you would recommend to find more answers about marketplaces?
Ooh.
I'll be 100% honest. I think the last book that I read was in high school. So I'm just not. I rarely sit down and read a book. I'm more of a documentary type person.
That's fine as well.
Sorry.
We'll go for it.
And
that's fine as well.
Yeah. So if you've watched all the documentaries around cruise ships and all the other fun stuff that you see in German television, I can recommend you one movie, which I always recommend, and it's The Founder. It's a movie around the McDonald's story, and specifically, it's the last, I don't know, maybe 1.5 minutes or 2 minutes of the movie, where he basically explains what made this entire McDonald's story so successful. And he said for him that it wasn't the education, that it wasn't the experience. For him, it was all around persistence. And I think that's something that I try to live every day, is to be persistent and hartnäckig in German. That basically when somebody says no, that's when we kind of really get going. So that's one thing. And then the second thing, which is old, but I think gold, is the commencement speech by Steve Jobs that he held at Harvard. You've probably heard sort of the famous words, stay hungry, stay foolish. That is the second thing I can highly recommend. Yeah, books would be Thomas Mann from 12th grade.
Thank you.
So maybe I have like 3 things. One is The Innovator's Dilemma, if you haven't read that. Then I think what I really enjoyed is The King of Oil. It's really about like commodity trading, and I think there's a lot to learn for B2B marketplaces in there. And then you might think of VCs what you may, but what they do see is a lot of great founders with great pitches, and they have pattern recognition in place. So there's really good content out there from a lot of VCs, and that's typically not books but blogs, or like napkins, or however you want to call these things. If you go through some of these, especially on B2B marketplaces, in the last 1 or 2 years, you can find a lot of good metrics, good success cases, and things to be distilled from that. So that's the 3 things I would mention.
Thank you.
Actually, I would recommend always reading From Zero to One. That's definitely something that gives you a certain perspective on markets. And apart from that, I think what I very often see when I work with others, that they do not really get on the ground of things. So if you really get into first principle thinking, that definitely helps to understand the reasons of things, if you have a methodology to go down to the right point. But I don't think, I haven't read a real good book about that, so maybe I have to write one. Or
I'm surprised the lean startup wasn't mentioned. It was like that. This was a hot shit in like 2015. Everybody would recommend you have to read the lean startup. If you want it, I have it at home.
I would have also recommended The Innovator's Dilemma. That's definitely something. And I enjoyed having seen him, and that was really one of the best presentations I've seen, and it was a lot about the things of the book he was telling.
Maybe one thing to add, when we work with founders that are still ahead of their pre-seed, so really very early and thinking about what to build, I mean, that knowledge won't come from books, right? I think there's really nothing better than talking to people and potential customers and just ask for the next intro, who should I speak with, etc. Because in the end, that's where you get especially if you don't have someone on the founding team that brings a known problem in a domain that they know very well. I think it's all about just talking to people until you find a pain point, as Martin said, that really sticks and where you feel there's some willingness to pay to solve it. I think that's the ultimate thing that every founder will have to do, and talk to hundreds of people.
So we had the mom test.
Sorry?
We
had
the mom
the
test.
book, The Mom Test.
Oh. All right, I think we can still get one question in. If anybody of you still has a question regarding marketplaces, founding companies in general.
Fire away.
This topic of what's first, chicken and egg. Both of you, I guess, you talked about cash flow, 24-hour financing for smaller carriers. And you said if you have VC money, eventually margins could be a thing to accelerate growth. Eventually, how would a VC look at this today in today's climate, where you also look not only at top-line growth in a marketplace, but also past to profitability, when you clearly see indications that you're financing growth via margins, or only via margins? Yeah. And secondly, how did you manage to get to a 24-hour cash flow to your suppliers at the beginning with 60 or 90-day payments from customers?
Yeah. Should I start? Or?
Yeah, maybe I'll take the first question. Yeah. So I think sacrificing margin for some time is okay if you do it intentionally to solve a chicken egg problem, right? And I would do that in alignment with the VC or the angels that are giving you the money, because it's not what they give it to you for at scale, but see it as an experimentation budget. And if you think it's a good experiment to run, to basically buy some initial access to supply or demand by being the price leader, hence sacrificing your margin, that can be totally fine, as long as you don't prematurely scale that, because then you're burning money, as also Martin pointed out earlier, right? So I think if you do that intentionally to either learn or buy some access into the market for some period of time, then it's fine. But don't mistake that for having product market fit. Mm-hmm. I think that's what we keep repeating, but we also see it very often. And then before handing over to Julius, I think on the financing, like cash flow problem, I think you can also do that with equity if you have some for in a limited amount of cases to learn from it, right? And coming back to building blocks I mentioned earlier, right now there are also really good like working capital providers out there, etc., that partner with early stage startups, which wasn't the case 5 years ago. So you can also partner with these to come up with like solving cash flow problems faster for your customers, etc. So there's more solutions now than having to do it only off balance sheet.
Yeah, maybe coming to the second question. First of all, let's remember that the egg comes from the chicken, right? And for us, the chicken was always the, I don't want to say more important side, but that's where basically our flywheel kind of started. And that was on the customer side, because in the end, we needed their shipments in order to utilize the carrier on the other side. Now, coming to your question in regards to the payment terms, 90 days on the one side, 24 hours on the other side. First of all, we only paid within 24 hours by taking a higher share of the margin. We had 24 hours, 7 days, and then 30 days was our regular payment term. So depending on how hard the liquidity was for the carrier, he basically had the option to choose. Now, when we kicked off this entire process, money was cheap, and we had I don't know, 150 million in the bank account, and interest rates were so low. In fact, we actually had to pay negative interest for keeping the money in the bank account, and then basically thought, okay, what do we do? And then developed this fast payment or accelerated payment back in the day. Now we have factoring providers in between that we use, but that's basically how we kicked it off, and how it works today is by traditional factoring providers in between.
So the answer is just have 150 million in the bank.
If that's what you took away from my answer, then
Extensive seed route, Philipp.
Okay, so maybe we will finish this off now. Thank you so much for your questions. Of course, you can still ask questions. It matters how long you will stay, guys. But we will take some pictures now. Just to let you know, there will be a newsletter mail after like 2 or 3 days. You can feel free to post a LinkedIn post or something like that. We will be, of course, happy to see that. And thank you so much for being here. All right.